Hello, everyone, and welcome to today's 2021 tax update. Today, Richard Smith, enrolled agent, owner of Richard Smith & Associates, and Paul King, CEO of King Wealth Planning and LPL registered principal, will be discussing how the current administration's tax proposal may affect your bottom line. Before I hand the mic over to Paul and Richard, I have a few housekeeping items to cover. First, today's session is being recorded and will be available through the King Wealth Planning website at www.kingwealth.com. Next, we'd love to hear from you during today's presentation. Due to compliance regulations, the chat feature is disabled. If you have a question for our speakers, please feel free to send your question through email to me at shannon@kingwealth.com. We will address questions at the end of the session. And that wraps up the housekeeping. Paul and Richard, over to you.
Thank you, Shannon. Here we are, a new administration always means new tax code, right? We've always got to tinker with the system. So happy to have Richard here today. He's been a great partner over the years. Has some real estate expertise, which we'll get into. But Richard, start us out. You are an enrolled agent, and just contrast tax advisor, CPA, enrolled agent. What's the distinction?
The biggest difference is I'm licensed by the IRS to represent my clients in all states, all 50 states. CPAs can have the same privilege, but only for the states they are licensed with. So most CPAs are licensed in California, and that's where they're limited to. Our expertise is tax only. We don't provide bookkeeping or payroll. We're a tax only shop. I've been here in the Valley for 40 years, and we specialize in helping our real estate clients and realtors. So it's a fun job, and like Paul said, we have new presidents, we have to have new tax law.
always new changes, and I don't envy your job sometimes. It's trying to keep up with it all, but also for our clients, trying to keep up with it all and what applies and what doesn't, and how do we do tax planning in an environment like this? So today we'll go through some of the nuts and bolts of what the Biden tax plan, is proposing, and then finish it off with some strategy talk. But we have some breaking news as well. So Richard just brought to my attention he's going to save me some more taxes this year.
So. I'm so excited about this. I'm kind of like busting all the seams. Our California governor just signed a new tax bill called AB 150. You might look that up. He signed it on Friday. And it doesn't affect your California taxes, but it allows you to deduct on your federal tax return for self-employed persons and some S corps. It allows you to take and deduct on your business entity your California taxes paid, but not deductible. Currently on Schedule A for itemized deductions, and those who don't itemize, most of our clients, like 90%, are not allowed to take their California taxes paid, which can run anywhere from $10,000 to $100,000. So the governor signed this new bill, AB 150. So in a case like I am, where I'm a Schedule C, self-employed, I will now prepare a personal partnership tax return for myself and my wife, and we'll deduct on that return the amount of taxes we paid to California. This is only since January 1 of this year. So that deduction, if we've not been able to take for 18 and 19 and 20, we'll now be able to take for 21. And for some people, it's significant. I have a client right now who's facing $170,000 in California tax, which he cannot deduct, but he will be able to deduct it on his S corp. So this is so exciting. I'm bursting all the seams. I want to tell everybody to run out and become a partnership or an S corp and get this new deduction, which can save you many thousands of dollars. Thank you, Paul. It's very exciting.
Yeah, that's a big one. But it doesn't save on California tax, it saves on federal.
Just federal tax.
So let's jump right in. I've kind of categorized some of these. They aren't really family rule changes, but I thought they impact, family with children, or all of us. So talk to us a little bit about the child care credits and deductions here.
These are proposed. Remember, Paul, I got to preface that every time I speak. These are all proposed. currently, persons who have children under 17 are allowed to take $2,000 deduction if they on their tax returns. Well, they want to increase that, so the proposed amount would increase from remember, this is a tax credit, so it's dollar for dollar. So in this case, the Biden plan proposes $3,600 if your child's under 6, and from 6 to 17 is $3,000 instead of $2,000. So that's really, really good. If they're over 17, the deduction drops to $500. But the most important thing here is that the Biden plan is already sending out advance credits. So if you have that situation on your 2020 tax return, children, there's income limits and there's a lot of other details, but they're sending out, in fact, my daughter got a check in July for $175. You want to know what it was? So it's kind of like when people were getting those recovery rebate stimulus checks, they didn't know what those were for either. So now, in addition to that, government's decided to send out the first 6 months of your child tax credit. I have to be careful how I say that. So, it's new. You're going to have to report it on your tax return if you received it. Now, remember, you're just using up your credits you would have gotten normally on your tax return. You're just using it up ahead. So up to 6 months of credits can be allowed for you. And that's a really, really good one. The other one is, Paul mentioned, the child care. This is where you deduct child care expenses for your child who goes to care, is kept in a child care facility. Currently it's $3,000 per child. They're going to raise it to $8,000. That's fantastic. I mean, we have a lot of clients who incur, child care to have your child watched by someone, and they spend a lot of money in California and deduct
a lot more than $8,000.
A lot more than 18 or 16,000 if you have 2 children. Now, again, there are going to be income limits, and there's always, some things that we don't put in our summary disclosure, but that's fantastic, and that means even people who have flex plans. A lot of clients, your employers provide flex plans for child care. This is really a good proposal.
And the last one is really for higher income earners, but here in the Bay Area can certainly exceed that. But this was a reduction under the Trump years, right? And we're just reverting back to what it was, the 39.6% rate.
Yeah, over 400,000. It was before 39.6 under Obama, and Mr. Trump reduced it to 37, and now Mr. Biden wants to put it back at 39.6. And so get used to seeing that number, 400,000. That seems to be the trigger point to determine if you're wealthy or not wealthy under the Biden plan, because a lot of these rules as we go through have a trigger point of 400,000. So, that's a big number, but we of course have people that exceed that. But, now remember, one thing I should have mentioned when I started, this plan has to originate in the House Ways and Means Committee, and then the Senate will vote on it. And so we talk about some of these proposals later on, it has to pass both the House and the Senate, and then they have to put them together and agree before the president would sign it. So some of these things we're going to talk about are really complicated, and does take very much in the Senate, 1 or 2 votes, and it won't pass on a particular item. But that's important to know.
A lot of negotiation and horse trading going on right now. And also point out that 39.6% is a marginal rate. It only applies to income above that level. It's not going to be on all of the income below 400,000.
Right.
And this has been their, talking points, is that people below $400,000 in income aren't going to see a tax increase, right? Why isn't it all this marginal stuff above that?
That's important. Thank you, Paul, because, we have lower brackets for lower incomes. We have the 10% to 12% to 22%. We have all these lower brackets, but, a lot of people would not make it, to 400, of course. But thank you for sharing that, because we always forget to say that. But it's only on the income above the trigger point, in this case, 400,000. So if you had 410,000, you'd only pay that extra tax on 10,000. So that's really important.
All right, let's get into the area that's probably of most importance to my clients in their portfolios, is all these capital gains, step up in basis. There's a lot going on here, and could be major impacts, right, for all investors. So let's handle that first one. Long-term capital gains, ordinary income, 39.6. So, but it's, you know, high incomes.
Yes, income over $1 million. So what the government does, they take your W-2 income, your interest, and your dividends, and that's taxed at regular tax rates. But for long-term capital gains, for assets sold that you've owned more than a year, it could be stocks, mutual funds, or real estate, even your own personal residence. So what they're saying is if you combine the two together, your regular wages and interest, dividends, and capital gains, for the portion over $1 million, you won't get this discounted rate. You know, it's currently 20%, but, you know, it will become ordinary income and taxed at 39.6. So a lot of people are asking us, you know, when would this become effective? And I think, you know, that they've got to raise money. We've been giving a lot of money away. Now they start raising money. This is long-term capital gains is easy because a lot of people are buying and selling stocks. And so, you know, they look to this as an easy one, and it won't affect people unless they have large amounts of income. But, you know, you've got to take a look at it. I have so many people selling their homes in Silicon Valley, and, you know, home sells for $1 million, and they got all their other pieces of income to add to that. So, you know, this is a tough law. This could cause some pain if you're selling the houses.
Yeah, and that's what we've talked about, you know, in California specifically, and I've had, I don't know, a half dozen to 10 clients selling homes this year, $1 million to $3 million plus, and you know, they've been in those houses a long time. It's already a big burden on them for the taxes that they're going to be hit with, but now we're going to double that.
Yeah.
That could be devastating, really. So
it's probably the most common question I get over the phone. You know, I just did one very interesting. He bought his house in Cupertino in 1967 for $16,000 and just sold for $2.6 million. You know, and that was all taxable, of course. In his case, sale of residence, you lived in it more than 2 years. Married couple gets a $500,000 exclusion. Single gets $250,000, but that's still a lot to pay tax on. Probably the most common question we get is sale of residence. We just saw one sell for $9 million. You know, and you hear what's going on. It's unbelievable what these homes are selling for.
And you know, we will touch more on some strategy at the end, but while we're on this subject, and you had touched on it, is sort of the timing of it, because we get that question. Is like, well, should I sell this year and try to avoid, you know, this increase next year? You know, what's the likelihood that it gets passed in this form? And then secondarily is, what's the timing of it? Would it apply this year if it passed this year?
That's really a great question. I thought it would be next year's, but now we find that they're working on a tax bill as we sit here and talk to you, and now they're talking about this fall. And the question always is, when does that new law go into effect? In the past, it's usually been the date the president signed the bill. Like I say, it's got to go to the House, and the Senate has to approve it, you know, for both of them to have the same bill and the president to sign it. So most cases, the date of signature. In some cases, it's been the date the bill started in the House. So now they're talking about the president would like to pick up some money this year. So there is a chance, I never thought we'd see it, there's a chance it would go into effect this fall. And that's important, because in most cases, very seldom do we have retroactivity. Once in a while, but very, very rare. But generally, I would say the date this bill initiates in the House Ways and Means Committee would be the first date to look at. Second would be the signature date. But, you know, they can push it forward. You know, in some cases, rare, they push it back. But that's the unknown. And we have a lot of people moving properties around, you know, due to Prop 19 and all those kinds of things early this year. So be wary of what the dates are. And we'll let you know as soon as we find out.
So let's jump to the last one, the deductions. Talk to us about what that limitation is.
Well, this is the one that bothers me the most, because it says eliminate step-on basis for death for capital gains taxes. So let's talk about your primary residence, which is what most people worry about. So on the death of the second person, that in the past, when that second person died, generally the wife, we would say, that property was appraised at the value of the date of the second death. And so the people who inherited that property, that would become their cost basis for sales. They could sell it immediately and pay no tax. And that's what we call step up in basis. And that's been the law as long as I've been in business. And that's always been the law. Well, now they're proposing, Mr. Biden's proposing, this shocks me, that on death, the people who inherit the property would pay all the taxes due on all the gains for the person who owned it. So they would tax that person who's deceased, their estate. They would tax her for the entire profit on that property on death. That shocks me so bad, I can't absorb it. Because we have homes here, like the one we bought for 16 and sold for 2.6. That means his heirs would pay the taxes on 2.6 million. It'd be long-term capital gains, at some rate, some 39.6 maybe. This is incredible. I can't even envision that passing. So what I keep saying to my clients, we only need one Democrat to step over who's got an expensive home that he doesn't want his children not to pay tax on. This is a difficult one to swallow.
Well, not just property, but, we do this on stocks too. I'm
Yes.
settling several estates right now, working with all the beneficiaries on their inheritance taxes or the potential taxes from the inherited assets that they're getting and what to do. And a number of them have, their own tax situation already. This is just going to exacerbate it. So, yeah, I agree. And we'll carry this over into the next slide, which is more about real estate. Did you want to touch on the last one?
Yeah, let me touch on it. That's not a big thing because we had that before. We've seen it several times while I've been doing taxes. What they're saying is they would reduce the value of your Schedule A itemized deductions. That would be reduced so that the value of those deductions, I didn't bring the 28% bracket with it. It's where most people are, around 28%. That you would not get all of your Schedule A itemized deductions, if your income was above a certain amount. But what's interesting today with the Trump tax plan in January of 18, 90% of the people today are no longer itemized. So, that's not as big a deal as it used to be. Here in California, because the interest we pay and the property tax we pay, we still have, I don't know the number, but I would say the majority of our clients still itemize on Schedule A. So, I didn't look at this as a difficult one, and we've done it before, so we'll probably go back to what it was before, is what it looks like. Go ahead.
So we talked about the elimination of the step up in basis. That's the big one. But maybe a little bit of good news, although in California this probably isn't as big a deal as the prices of properties, but nationwide, first-time home buyers tax credit.
Yes. I remember we did this before. It was 8,000. I don't know, maybe it was more than 10 years ago. I'm trying to think. It was such a good deal. I don't hear much feedback on this one. There are people, again, everybody's got their own political, strategies, but that's what they're saying is we might give a home buyer credit up to $15,000. So if you're buying a house for $1.5 million, I hope it helps, but it'll help other places better than it will here.
Yeah. Well, and so much of tax law, right, has some social aspects to it, and we're trying to get, new people into homes. So, and then 1031 tax deferred exchanges. I know you're big in real estate, and got a lot of investors that you work with. Talk about, that.
That's a big one. That's a big one, Paul. And we lost all the other exchange possibilities in 2018, and we were able to preserve the 1031. I do 3 or 4 exchanges a year. So what they're talking about here is if you own a rental property and you sell it and you give the money to an exchange facilitator and you buy another property with certain rules, you don't have to pay any tax on the property you sold. So that's fantastic. We all upgrade our portfolio by selling one and buying 2 or 3. That's what I've been doing for 40 years. Well, now they want to eliminate that. So I hope one of those Democratic congressmen will come with me and not allow that to happen. But what they changed, they said, okay, we'll allow tax-free, 1031 tax-free, tax-deferred exchanges up to the sale of the property for up to $1 million. Well, I read, we get weekly comments on this, and now they dropped $1 million to $500,000. So I don't know what's going to happen. I mean, if you're out of state and you're doing this, it's still pretty good. I mean, I'm in the Sun Belt and things are pretty reasonably priced. This won't help anybody I know in California, but I hope this won't happen. It's what I hope for my real estate investors out there. And but it's still on the list. I hope it doesn't pass.
Well, and it reminds me back in the 80s when we had major tax law changes around real estate, and it, this one doesn't have the same type of effect, but so much of that shut down a lot of what was happening in real estate and devastated real estate for a number of years.
Well, there's a few others that Paul didn't put in here, but I just want to bring them up to a couple people. Biden is proposing he would increase the top corporate rate from 21 back to 28. Well, it was actually higher than that, but that's what he's looking at. He also are proposing possibly a new credit for residential energy. I just bought a plug-in electric car, so I'm still looking forward to that kind of credit, at least until we get that. And there's other things in the bill. In fact, there's the one that's the biggest, and we didn't mention it, was that currently you're allowed, when you pass away, that the first $11.7 million of your estate is not taxed. So for a couple, it's 11.7 each. Well, that means the first $23 million of your estate would not be taxed. Fantastic. I came from the Trump tax plan in January of '80. If you remember, Mr. Biden, he was the vice president, not the president. When Mr. Obama was president, the maximum then was 3.5 million per. So a couple could have $7 million of untaxed estate value at death. So, that's very concerning to me too. Not as much, as possibly some of the others, but the current law, 23 million, that takes care of most people I know. But at 7 million, I know people who would be exposed, and 3.5, I guarantee you, there are people that would be caught in that threat. So that's another part of the law, and I don't know how that's going to weather, because most of our congressmen are pretty wealthy, and I hope again one of those Democrats will step over in the Senate and kill it. So yeah, there's more changes. This is a good summary. Again, remember, this is all proposed. And we don't know what will pass. But we'll keep you posted. And when it's going to pass, it's beginning to look like we might get some of this year. So that's very concerning to me. And so that's just as important as when would it take place. And we don't know. We're just now telling you we could see it in the third or fourth quarter of this year.
Yep, certainly would bring estate planning back to
Yes.
a number of people that, really didn't have to do any significant planning.
Yes.
So let's talk a little bit about kind of strategy and we touched on it in the past, is, are we jumping the gun by trying to do too much on a proposed stage? How likely is it to pass? Do we wait till, it's actually passed to make planning? Kind of, talk to us about your experience in that and,
Well, the thing I recommend is go talk to your estate planner. And I'm finding they're super busy because Prop 19, which went into effect in April, has caused a lot of conversations for some of our clients with multiple properties. We have a client who's got a property, a multiple apartment building. He's property taxed at $2 million, but it has a value of $10 million. So, if that were to step up, his children could not afford to pay the taxes on it.
Yeah.
So there's a lot of those things that, the realtors, voted for Prop 19. I'm not very happy with Prop 19, but I think you need to visit your estate planning attorney. Now, when I look at the things on this list, a lot of these you're going to have to learn to live with, the bracket changes and the extra things and things like that. So, I'd say you need to start by talking to Paul and your estate attorney and think about your estate planning, because that's the most important thing that I see. And the other part of it is, about stocks. Most people, taxes don't feed their stock sales. They've got a plan they're living with, and, they're going to sell no matter what the tax rates are. So that I don't see as a problem. But I am concerned, about the killing the step-up basis. And the other things, we'll learn to live with them. I've been doing taxes 40 years. I've seen many tax proposals, and there's things that aren't in here that they want to take out of the Trump plan. I didn't mention them. There's those things that, they're getting back at Trump, and they want to delete some of the things he did for self-employed people, like giving us a new 20% deduction, like to take that away. I mean, we'll live whichever way that goes. So I think the key is to really do some planning, estate planning, tax planning for every one of you, because, things are going to change. Let's say it that way. There's going to be changes, and we'll conform and we'll strategize for you, and we'll help you get through it. But, there's a lot of it. You're still going to continue to try to make the most money you can and preserve your estates for your children. And, maybe you're going to leave California, but this is not a California thing, And I don't know. I think there's so many questions that we just want you to start thinking about it and maybe try to do planning before year end. That's what I would recommend.
Well, and it's, we know taxes continue to
Change.
go up, change for sure, tend to go up over time.
Yep.
So, there's a lot of tax strategies we
Yep.
can apply and just makes them more important over time and revisit those. So I think we'll close it up here. Shannon, if there's any questions, for those of you on the call, Richard does put out some tax updates. We'll put you in touch with them if you just ask me for that. With all these moving parts, I tune in for his updates all the time. What really prompted this webinar today? So
Yeah. Well, Paul and I are now looking at AB 150 because we're both going to benefit from that. And I just went through my customer list the other day to see how many people would benefit from AB 150, and I had a couple hundred people. And the good news on AB 150, if you've got a partnership already or you've got an S-corp already, you just plug it in. Now, the other people, like myself, Schedule C people, self-employed, I'm going to be a partnership tomorrow. I've already filed for my federal ID number. I'm becoming a partnership tomorrow.
Yeah.
So that is a unbelievable benefit that we can take. And I encourage you to get focused on the AB 150. I encourage my clients to do tax planning. We do a lot of tax returns, and probably 10% of our clients actually plan.
Yeah.
Well, maybe this year you'll plan some more because you attended this webinar or read one of my newsletters, because I think this year more than ever is when you need to sit down and if we have a new tax bill, it's critical.
And vice versa. We say we do tax planning. We don't do any tax prep or give tax advice or, tax law. So that's what makes a great partnership between the two of us is,
Thank you.
You plug it in, you tell us what's really real. I have some ideas. Yeah.
We want your ideas to work. Thank you, Paul.
So we're moving into the Q&A segment of the webinar. Let me remind participants to email questions to me at shannon@kingwealth.com. Also, after the webinar, please take a moment to complete a brief survey so we can keep these types of offerings relevant and meeting your expectations. I don't have any questions coming in yet, but I have a question that I actually had asked Richard earlier, because I was looking at selling my house and trying to figure out the tax liability, and I didn't understand the adjusted cost basis and if the amount we still owe on our mortgage comes into play in that calculation.
That's a great question. The most common question I get is, what's my tax going to be and what about my mortgage? Remember, when you sell a house, it's like selling a stock. We're going to look at what you paid for it, what you improved it for, and how much you sold it for minus your selling expense, which is, run you 6 or 7%. So we determine what your taxable profit is, and it's long-term capital gains. So, it's 15 or 20%. And if you're a married couple, the first $500,000 of profit is not taxed. If you're a married couple and you owned it for more than 2 years, single person gets a $250,000 exclusion. And so those are the basic rules. Now, when people ask me, I try to do it without running hard numbers for them. So I say, let's you and I do this together. And we'll take our cost plus our improvements, subtract that from sales price minus sales cost, and we'll find out what that bulk of that money looks like, and then we take out the 500 or 250. Now, that money that's left is your taxable profit. Now, I just use a rough number, like 30% of that amount is what you'll pay tax on. Now, it could be a little bit more, it could be a little bit less, but that's the number I use, is about 30%. Because you're going to add that gain. Say the gain's $400,000 or something. Remember, you're going to add that gain on top of your W-2 wages and interest and dividends. So pretty easy to get it to 30 to 35%, actually. So that's what I was sharing with Shannon. Go back and figure out how much you spent. Now, people always ask me, I don't have proof for all the things I spent. The only audit I've ever had in 40 years they don't audit residential sales, and I'm amazed they don't. But the one I went through, the client had no receipts. It was a divorce, and the husband took all the records. So she wrote down on a piece of paper everything they'd done to this house in the 20 years. And they had a pool, and they had solar, and they had landscaping, they had all the inside and everything else. Wrote down a piece of paper. and gave it to me, and I reviewed it and gave it to the IRS, and they accepted it. So the good news is they don't audit very much, but that's not the reason to be slippery. That's the reason to do the best job you can. Now, I've had people come to me, they have every document they've ever spent in their house. I'm always impressed with that, because I couldn't do that. But, you know, that's what you have to figure out. And we have so many people selling today with huge, huge profits. I mean, I'm shocked when I see the kind of numbers people are coming in. And they're going to pay 30 to 35% on their gain once we determine what their gain. Remember, it's those four numbers: cost plus improvements subtracted from sales price minus closing cost. And you can figure, you know, 6 or 7% of the sales price is about what your closing costs are going to be. And that's going to give you a number, and then you're going to subtract either 500 if married, 250 if single, multiply that by 30%, you'll be in the ballpark. So, you know, call me if you have any questions, but that's the most common call I get, and I enjoy talking to these people and seeing what they're selling for. Amazes me. It just amazes me. I just had my house approved for a new HELOC. I don't believe these numbers. Paul, I mean, it's just shocking.
You know, as we've talked about a strategy to sell with no capital gains. It's you know, it's rather complicated, but there are possibilities.
Yes, there are.
And I like to show clients that.
Yes.
You decide how you want to.
Yes. And a few people come to us with those strategies. I'm happy for them, because we end up doing some of those strategies. That's incredible. You know, I don't always think of that, because, you know, that person is not probably going to come see me because they're not going to pay any tax. You know, so yeah, the Delaware Statutory Trust and all those other possibilities. You know, I don't think enough people know about it, Paul. We should do a seminar on that. Yeah. Let's do it.
So the problem is, or the opportunity is that California real estate has appreciated so much, so it opens up those possibilities.
That's fantastic. Thank you for saying that, because now I have few, you know, every year we'll do 2 or 3 of those, but for the number we'll probably do, you know, 5 times as many that just pay the tax.
Yeah.
And I'm always shocked when they just write those checks. I mean, I guess you have $1.5 million sitting in your bank account, you know, you can pay $200,000 or $300,000. That shocks me.
We call them patriotic.
What I would do is I'd convert it to a rental and move out of it and rent it for 2 years. And I've done this myself. And I would do a 1031 exchange like I did and buy 8 homes in Atlanta. Now I make $90,000 a year. So there's so many ways, and people never ask.
Yeah.
The problem is you don't ask. So if you're talking about selling your house, go visit Paul, talk to me, talk to somebody about not paying all those taxes. You could buy your children a house with the taxes you're going to pay. You know, so please don't pay all that money if you can avoid it.
Well, it's true for stocks too.
Yeah.
Kinds of exchange funds and different ways to avoid tax.
Yeah, that's great news that there's some strategies out there, so we don't have to pay all that capital gains, especially if it goes up to 39.6% in the fall. So,
and plus you got to pay California on top of that.
Yeah.
Another 10 or 11% to California on top of 39.6. You're talking 50%. I mean, that's a shame.
It's half. It is. It's your money. It's really sad. Okay, I think that's a wrap. Thank you all so much for participating. Thanks, Paul and Richard, for bringing this valuable information to us. We wish everyone a wonderful rest of the week, and we'll see you at the next one in August.